By March 19th, a modicum of calm was restored in the global banking system. But this was thanks only to global central banks and other strong lenders pumping in significant sums of emergency cash. According to a CNN report, the rescue has cost close to $200 billion so far in direct central bank support. Here's the breakdown of the numbers. Guaranteeing all deposits at the Silicon Valley Bank and Signature Bank could cost the US Fed $140 billion. Meanwhile, the Swiss National Bank has offered Credit Suisse $54 billion in the form of an emergency loan. The report says that banks have also borrowed over $150 billion from the US Fed in recent days, beating the previous $112 billion record set during the 2008 crisis by a considerable margin. Overall, the $318 billion the US Fed has loaned to the broader financial system is almost half the sum that was extended during the global financial crisis. The current crisis began on March 10th, when the biggest failure of a US bank since the global financial crisis came to the fore, with US regulators taking control of California-based Silicon Valley Bank. SVB's collapse was the consequence of the US Fed rapidly increasing interest rates. They also shut down a second US regional bank, the New York-based Signature Bank, on March 12th. Meanwhile, a third, the First Republic Bank, had to be propped up through a private sector rescue. But the crisis deepened on March 15th when Swiss authorities announced a backstop for Credit Suisse, which is among the 30 financial institutions known as globally systemically important banks, after watching its shares collapse by as much as 30%. The situation at Credit Suisse turned critical when a key shareholder refused to provide additional support through the infusion of capital. Finally, on March 19th, an emergency rescue deal was hammered out, with Switzerland's UBS agreeing to buy Credit Suisse. Closer home, Economic Affairs Secretary Ajay Seth told a financial daily that the crisis at Credit Suisse, along with the collapse of two American lenders, was unlikely to impact India's banking system or its broader macroeconomic stability. While stating that the present situation was nowhere near the level of the 2008 crisis, Seth cautioned that global capital flows could be adversely affected if the crisis became more pronounced. He said that the government, the Reserve Bank of India, and SEBI were monitoring any potential spillover. A recent report by Jefferies India also indicated that India's banking system is expected to remain unaffected by the troubles at Credit Suisse because the Swiss lender has a very small presence in the country. But what do experts think? Will the Credit Suisse crisis and the turmoil in the broader sector affect the Indian banking system?
All the three banks are unique cases. As far as Indian banks are concerned, I think we are reasonably well capitalized. Our, if you see look at the health of the bank, it's pretty resilient. The provision coverage ratio is pretty good of all the banks, on the very high side. And if you see the last 1 year, every quarter is a better quarter for the banks than the previous quarter. So in terms of quality of credit, in terms of interest income, everything. So I think we should not have any exaggerated fear about the entire banking system. It's fairly resilient, fairly robust, and it has nothing to do with what we have seen in US and Europe in the past 1 week.
To my mind, I thought the Indian banking is a very layered banking. The regulator has actually paid much more attention in sort of risk management rather than the banking companies themselves, to the extent that if you look at the regulations, there are several layers, and it's very difficult really for a bank really to, like for example in Credit Suisse, to get away without disclosing any material impairment that may have happened to its valuation. So to that extent, I mean, I would say the Indian regulator has really worked out very well, in terms of putting a lot of caution around. Second is the size itself. No Indian bank will ever carry, because the regulations do not allow them to carry a particular exposure. I mean, it is to be diversified exposure, which means there are prudential norms associated with, conservative norms associated with exposures in any given sector, in any given company. So all that is already established. So to that extent, I mean, I would certainly say that the spillover to the Indian banking may not be there.
the Indian banking system is likely to prove resilient in the face of the current global crisis. However, continued caution and vigilance on the part of the government and regulators is warranted. Both investors and experts believe that even after UBS Group's takeover of Credit Suisse and the announcement of new dollar liquidity measures from central banks, the turmoil in the global financial system still has room to run.
If you like this video, share it and subscribe to Business Standard. For more news, views and insights, log on to www.business-standard.com. Do also follow us on YouTube, Twitter, Facebook, Instagram, Telegram and LinkedIn.